Right now, as we look at the tapes, Strive Inc., ticker symbol ASST, is sitting at exactly 98 cents. That is a drop of roughly 6.99% on the session so far, dragging the stock down into a psychological danger zone that few investors ever want to see. When a company with this much media attention and high-profile backing breaks below the $1 mark, it triggers a very specific, visceral reaction in the market. You are looking at a chart that has gone from a morning flush, attempted a weak stabilize, and is now hovering at lows that invite aggressive speculation. The volume is ticking over, but the price action is heavy, lethargic, and frankly, concerning for anyone holding a long position from higher levels. You might look at this price tag, under $1, and think you are staring at a massive discount on a company that has been pitched as the next major evolution in corporate finance. The expectation here was sky high. The narrative sold to the retail public was that Strive Inc. would become a premier Bitcoin treasury vehicle, leveraging the celebrity status of its founders and an anti-ESG mandate to capture massive institutional capital. The expectation was that ASST would act as a high beta leverage play on Bitcoin, soaring as crypto assets gained legitimacy. The reality, however, is significantly more brutal. The reality is that the market is currently pricing in a failure of execution, a massive overhang of paper supply, and a disconnect between the corporate vision and the immediate liquidity needs of the stock. We are not just seeing a red day. We are seeing a repricing of risk that suggests the market does not believe the current treasury strategy can outrun the operational burn and potential dilution waiting in the wings. Let's look closer at the intraday movement because it tells a story of exhaustion. The stock opened near $1.03, tried to push toward $1.04, was immediately met with a wall of selling pressure. This isn't algorithmic chopping, this is distribution. Every time the stock tried to lift its head above the $1 level earlier in the session, someone was there to hit the bid. When you see a stock struggle to hold a round number like $1, it becomes a self-fulfilling prophecy. Day traders see the weakness and short it. Long-term holders see the digit change from 1 to 0 and panic sell to preserve what's left of their capital. The slide to 98 cents is technical damage. It breaks the psychological floor. If this closes below $1 today, it starts the clock on NASDAQ compliance warnings, which adds an entirely new layer of bearish pressure to the narrative. But why is this happening now? To understand the drop, you have to look at the broader setup. Strive Inc. is effectively a new company and an old shell. The merger between Strive Enterprises and asset entities was supposed to be a clean entry into the public markets, transforming a digital marketing and Discord community business into a hard asset Bitcoin treasury firm. The problem is the friction of that transition. Investors who owned ASST for the social digital play are likely exiting because they didn't sign up for a crypto volatility play. Meanwhile, new investors are hesitant to step in until they see proof that the company can actually accumulate Bitcoin without destroying shareholder equity through excessive dilution. The recent preferred stock offering and the talk of warrants have spooked the market. You cannot raise hundreds of millions of dollars to buy an asset without the market worrying about how many new shares are going to flood the float. That is the dilution fear currently pinning this stock to the floor. Let's talk about the business model briefly, because it is essential to understanding the risk here. Stride Inc. is positioning itself similarly to MicroStrategy, but with a wider mandate on unapologetic capitalism. They are raising debt and equity to buy Bitcoin, betting that the appreciation of the underlying asset will outpace the cost of capital. When Bitcoin is ripping to new highs, this model looks like genius. The stock acts like a leveraged ETF. But when Bitcoin hits a patch of turbulence, as we have seen recently with the dip below the $100,000 level, the leverage works in reverse. The premium that ASST trades at relative to its holdings collapses. Right now, you are seeing that premium evaporate. The market is stripping away the hype value and trying to find the book value. And for a company that is still integrating a legacy digital marketing business with a new financial treasury mandate, the book value is murky. This brings us to the elephant in the room, short selling. You absolutely cannot discuss ASST without addressing the short side of this trade. Reports indicate that short interest in ASST has been climbing significantly, with some data points suggesting it is hovering around high double digits of the free float. This is a crowded trade. Short sellers are betting on two things: dilution and delisting. They believe the company will have to print significantly more shares to fund its Bitcoin purchases, which will drive the price down mathematically. They are also betting that the stock will get stuck in the sub $1 seller, forcing a reverse split, which typically invites even more selling. But this high short interest creates a coiled spring scenario. If you are watching this stock, you need to check the cost to borrow fees at your broker. When borrow fees spike, sometimes hitting 100% or more annually on hard-to-borrow stocks, it means shorts are paying a fortune just to keep their positions open. If Bitcoin were to suddenly reverse and surge back over key resistance levels, or if Strive announces a strategic financing partner that doesn't involve immediate dilution, the shorts could be trapped. This is the squeeze thesis. At 98 cents, the risk-reward for shorts changes. How much lower can they realistically push it before profit-taking kicks in? 80 cents? 70 cents? The upside risk for a short seller is infinite, while the remaining profit potential is capped at 98 cents. This asymmetry is what retail bulls are banking on. But do not be naive. A short squeeze requires a catalyst. It requires volume. Today's volume is high, but it is selling volume. To trigger a squeeze, you need aggressive buying that forces shorts to cover at market prices. We're not seeing that yet. We're seeing a slow bleed. Retail sentiment online is mixed, to say the least. On forums like X and Reddit, the conversation is polarized. One camp is screaming manipulation and calling for a coordinated buy to punish the shorts. The other camp is calling it a rug pull and warning that the pivot to Bitcoin was just a way to sell shares to hyped-up retail investors. I want you to take a second and comment below. Do you think the pivot to a Bitcoin treasury model was a genius move by the founders, or was it a desperate attempt to save a flagging stock? And if you are holding, what is your average price? I'm seeing averages all over the map, from $4 down to $1.20. Let me know where you stand. Let's investigate the macro pressure. Small-cap stocks, specifically those in the Russell 2000, have been under immense pressure due to interest rate uncertainty. Strive Inc. is a small cap. It relies on capital markets to function. If rates stay high, the cost of borrowing money to buy Bitcoin becomes expensive. That eats into the margins of their treasury strategy. You also have the regulatory angle. The founders have political connections and a very public profile. While this brings attention, it also brings scrutiny. The market hates uncertainty. Will there be regulatory hurdles for this new structure? Will the SEC look closely at the merger details? These unanswered questions act like a wet blanket on the price stock. Furthermore, we need to discuss the technicals on the daily chart. We have broken the 50-day moving average. We have broken the 200-day moving average. We are now in price discovery to the downside. The next major support level historically for the ticker ASST, back when it was just asset entities, is in the 60 to 80 cent range. If 98 cents doesn't hold by the close today, the algos will likely target that 80 cent zone next. That is a further 20% drop from here. This is why catching a falling knife is so dangerous. You might think 98 cents is cheap, but 80 cents is significantly cheaper, and the market has no loyalty to your entry price. However, there is a counter-argument, the smart money accumulation. Often, before a major run, market makers will flush a stock to clear out the weak hands, the retail traders using high leverage or tight stops. They push the price below a key level like $1 to trigger a cascade of stop-loss orders. This provides the liquidity they need to buy huge blocks of stock without spiking the price. Is that what is happening here? Is this a bear trap? It is possible, but you look for confirmation. Confirmation would be a strong close back above $1.05 on massive volume. Until you see that, the trend is down. The trend is your friend. And right now, the trend is bearish. Let's shift to the future outlook. What are the catalysts for 2026? The biggest one is obviously the price of Bitcoin. Strive Inc. is now tied to the crypto market. If we see a crypto winter, ASST will hibernate or freeze to death. If we see a super cycle, ASST could be a multi-bagger. But there is also the operational aspect. Can they monetize their digital communities? Remember, they still own the asset entity's business. If they can turn those Discord servers and TikTok marketing channels into cash flow positive assets that cover their overhead, that would reduce the need to sell stock. That would be the bullish pivot, a self-sustaining business that stacks Bitcoin with its profits rather than with shareholder dilution. That is the Holy Grail. But we have not seen the earnings reports yet to confirm that is happening. Investors need to be aware of the file to deliver FT